and bonds, and that real estate lies somewhere in between. Therefore, in the most widely accepted hierarchy of risk, stocks are at the top, followed by real estate, with bonds near the bottom. Volatility can be a good proxy for risk, particularly in the short term, as illustrated by the college tuition story just told. However, volatility is only one dimension of risk, and sometimes volatility doesn't even matter. If the stock market goes down a lot this year, for example, that's not at all a risk for you, except if you're intending to sell stocks soon to make a significant purchase. Price declines matter only when people are selling. But because volatility can be quantified, whereas other risks cannot be, economists and investment firms have latched onto volatility as the sole proxy for risk. That's an incomplete view of the world. Investment models. To navigate through the fog of finance, academics use mathematical models. Academics love models because they reduce very messy, real-world living to simple formulae that can fit on a classroom blackboard. Some models are highly respected. One, the capital asset pricing model, won its creators a Nobel Prize. Use models, but don't believe them. Models can be useful, but in only a limited way. First, the good news. Some models, including the capital asset pricing model, describe how markets are supposed to behave, and such descriptions are useful in understanding basic principles, such as the virtue of diversification, the equity risk premium, and so on. But the bad news is that models fail in at least two important regards. First, models fail to account for human nature. They describe how markets are supposed to behave, but real-life markets, not knowing the expectations with which economists have burdened them, don't behave that way. A whole new field called behavioral finance has arisen to explain how investors actually behave. Because real-life behavior cannot be described mathematically, economists' models are incomplete. Second, many models assume that outcomes are normally distributed. In lay terms, they assume that outcomes fit within what are known as bell curves. Bell curves are good at describing normal circumstances, but circumstances are not always normal, and abnormal circumstances are the dangerous ones. Imagine a black line that plots investment returns on the horizontal axis and the probability of earning those returns on the vertical axis. This bell curve is derived from a commonly used theoretical model. The most likely outcomes are clustered near the center, around the average. Extremely low returns and extremely high returns are quite rare. But real life looks more like a flatter bell curve. In many situations, including in financial markets, extreme events happen more often than the models predict. This is known as a fat tail problem, because events at both ends of the curves, at the tails, are more common than expected and are often quite consequential. The fat tail events with which we're most familiar involve the weather. 100-year floods seem to happen not every 100 years, as models would suggest, but rather once every decade or so. The most extreme financial event in my lifetime was the October 1987 U.S. stock market crash, when the S&P 500 index declined by 23% in just one day. According to standard stock market models, that 23% single-day decline should happen only once in every 3 trillion years. That was a fat tail event. Investing for income. A small number of investors have very long time horizons and have enough capital that they can afford to live off the income that their capital generates. This is a game changer. So-called income investors don't have to worry about market values at all. For them, all that matters is the stability and security of their income sources. In the United States, at least, dividends from equities, in particular from the S&P 500 Composite Stock Index, have been far more stable than the market values of those equities.